5 financial shifts every Indian must understand this week, ending 24th July. Oil crossed $100. Rupee moved dangerously close to its record low. ITR deadline became within a week. SEBI changed how families can claim their shares and investments after an investor's death. A proposed one-click UPI system has raised questions about whether convenience should quietly reduce consumer choice. They're not separate stories. They are together. They reveal 5 new tests for every Indian family's financial plan. Today, I'll explain what changed, what is being misunderstood rather, and what you should or should not do next. Good evening. This is Taresh Bhatia. Welcome to the Taresh Weekly video show. 5 headlines, 1 family balance sheet. 5 money shifts this week. Good evening. Welcome to the show. Every week, I, Taresh Bhatia, a certified financial planner, go beyond the financial headlines to answer one practical question. What do these developments actually mean for Indian families, professionals, entrepreneurs, retirees, maybe NRIs? This week, 5 major shifts to deserve your attention. So this week, 5 major shifts. First is the crude oil, which obviously crossed $100 and rupee moved close to its record lows. Second, the geopolitical risk increased because global equity markets responded very differently. Third, the Indian large cap valuations became relatively more attractive after the substantial foreign investor selling. Fourth, the artificial intelligence investment boom began raising an important question. Can a genuine technical revolution still create excessive valuations after over investments? And finally, SEBI introduced a more standardized procedure for transmitting shares, demat holdings, mutual fund investments after an investor's death. We'll explore these 5 developments which may appear to you unrelated, but they share one message. Financial intelligence is not about reacting fastest. It's about separating a genuine change from temporary noise and then connecting the change to your family's financial plan. Today, I'll explain what changed, what remains uncertain, and what you should review without making any panic decisions. The shift 1 is the oil moving above $100 serious but not unprecedented. This shift 1, the $100 oil and the Indian family, because the Brent crude crossed $100 per barrel, perhaps escalating the conflict and risk involving important energy and the shipping routes. At the same time, the Indian rupee moved close to its record low. State-run banks are reportedly selling dollars, which market participants interpreted as possible RBI intervention to contain excessive volatility. For India, expensive oil matters because we import most of the crude oil we consume. Higher crude prices can affect, obviously, price of petrol, diesel, aviation fuel, transportation and the logistic cost involved, imported goods, corporate profit margins, inflation expectations, bond yields, the current account, and the rupee. So I want to add some historical perspective if you would like to understand what it actually means below the headlines. So oil has crossed the elevated levels before also. There was a major pre-financial crisis spike. If you remember, the oil remained above high levels in 2011 and 12 also. It surged again following the Russia-Ukraine conflict in 2022. And the important question is not merely, crude oil crossed $100 for the first time. No. The more important questions are, how long will it remain elevated? Is the increase a temporary geopolitical crisis spike or a prolonged supply disruption? How effectively can the Indian economy absorb this pressure now? This is very important to understand because beyond the one-sided perspective, you have to understand the other side of the perspective. So a temporary spike and a prolonged energy crisis do not produce the same economic result. But let me ask you, is India better prepared today than maybe a decade ago or 50 years ago? India does remain vulnerable to imported energy cost, but this may not be so much understated for that matter. Why? Because India today is also a substantially larger and more diversified economy than it was during the previous periods of $100 plus oil. That India's crude demand has grown since 2012, financial year 2012. GDP has grown faster. According to the crude import burden relative to GDP is lower than it was during the earlier high oil period. This is a useful perspective because it must be interpreted very carefully. It does not mean that India is immune to expensive oil. It means that the economy may have a larger hull with which to absorb the storm. India today benefits from major factors like a larger domestic economy, a wider services sector, greater formalization, digital financial infrastructure, a significant foreign exchange reserves. However, none of these advantages actually cancel the cost of importing energy. I would monitor 4 pressure gauges. What are these 4 pressure gauges which may help us to understand? First is the bond yields. A substantial rise may indicate concerns about inflation, government borrowing, and the substantial monetary conditions. Second, the manufacturing and the services sector. Now, these indicators help us to assess whether business activity remains in expensive or an expansion zone despite higher input costs. Third is the inflation starting point. An oil shock is more difficult to absorb when inflation is already elevated. A moderate starting point today gives policymakers more room, but it does not remove the risk at all. The fourth point to consider and think about is foreign exchange reserves. Now, reserves give the RBI greater capacity to manage disorderly currency volatility. They are an important buffer, but not an unlimited shield or rather guarantee for any particular rupee level. So you may ask, Taresh, what should the families do in India? And they would tell me, don't predict. Stress test is better. So oil above $100 is not an instruction to sell equity or immediately buy gold. It's a threshold, household threshold stress test, I would say. And how do you take this stress? Ask 4 questions. Can your monthly budget withstand moderately higher transport and living cost? 1. Do you have an adequate emergency reserve built for this purpose? 2. 3. Are any major education, travel or business payments due now or maybe due in dollars? 4th is our portfolio excessively concentrated in businesses vulnerable to energy cost? And finally, a child's overseas tuition cost or education cost may simply mean a 40 lakh or a 50 lakh goal. It's a foreign currency liability with a specific payment date. Similarly, an entrepreneur importing equipment has a currency and commodity linked obligation. The responsible response is not to predict tomorrow's exchange rate. It is to identify how much of the known requirement remains exposed. Therefore, let me conclude the first shift. A $100 oil price is not a portfolio instruction. It's just a reminder to strengthen your family balance sheet. Let me come to the second shift. The geopolitical risk is high, but markets do not move together. So with all this geopolitical risk now coming center focus and people thinking everything is dependent on that, well, the global risk is different from the market returns. The global risk index, if it was there and is there, has risen sharply during the periods of war and international tensions also in the previous years. The index is constructed from the frequency of geopolitical risk appearing across major newspapers. It captures the reported threats, military tensions, and adverse geopolitical events for that matter. But it's not a stock market forecasting tool. An increase in geopolitical risk can influence what? Maybe energy and commodity prices, shipping routes, supply chains, currency movements, defense expenditure, and corporate investments. And finally, the consumer confidence. However, markets may react before the event, during the event, or after it. So a market may even recover while the political and humanitarian crisis continues. And that is why geopolitical risk index should be used as a stress test for your portfolio, not as a signal to move complexity into and out of the equity markets. Let me come to another aspect, the same world with different returns. So global markets having the same storm, but having different outcomes. So the June market if I compare with the previous months, shows how differently Indian, or rather I will call the individual countries across the planet, responded to the same global environment. During the measured responses, Japan was amongst the strongest equity markets. Switzerland, sections of Europe and Europe would have performed positively. India delivered a comparatively modest positive return. Meanwhile, countries like Indonesia, Hong Kong, Russia declined. And the exact figures depend on the index, currency and cutoff dates. Therefore, they should be treated as point-in-time comparison, not permanent rankings forever. So what's the important lesson here? Japan's markets was supported greatly by the corporate governance reforms and the shareholder-friendly measures in that country. On the other side, Russia faced sanctions, interest rate pressures, and geopolitical constraints. So what is India's relative performance? Was it affected partly by the significant foreign investor selling? Over the years, over the decades, I can say that global diversification is valuable precisely because the different markets respond differently to the same event on the same planet. But diversification does not mean repeatedly shifting money into a country that performed best last month. International assets should have a defined role in a portfolio, whether it's a mutual fund portfolio or stocks, because of a couple of reasons: geographical diversification, currency diversification, access to sectors that may be underrepresented in India, and perhaps reduce dependence on one economy. Therefore, the best performing country in 1 month is not automatically the best investment for the next decade. Don't make that as a yardstick. Now the shift 3. Indian large caps. Big questions have come to me. Has the risk reward changed? Therefore, I brought in this third shift, which is within the Indian equity markets. The question is, large cap equities were trading 10%, approximately 10% below the 7-year median price to earnings multiple or technical, which parts of the small and mid cap markets remained comparatively expensive. So independent historical index data that the Nifty 100 was trading below several of its historical median valuations in July have been reported, but we need to use the correct language or make it simplified for you. Below the historical median does not necessarily mean deeply undervalued. It's slightly technical, but let me say that the price to earnings ratio must be examined with a couple of factors: earnings quality, future profits, interest rates, sector composition, corporate leverage, return on capital, and the economic environment around what we see. A total of this can look inexpensive because its price has declined. It can also look inexpensive because the market expects earnings to weaken. Therefore, valuation is the beginning of any analysis, what I would do, and not the final conclusion for that matter. Now, coming to the point of foreign sellings. Is it a FPI selling pressure? And what do we conclude from this? The foreign portfolio investors repeatedly withdrew substantial amount from Indian equities between, I would say, March till June, because foreign institutions own large liquid companies, large cap shares, therefore can face disproportionate selling when global investors reduce emerging market exposure. What does it mean for you? This may produce temporary price pressures even when the underlying companies remain fundamentally strong. But we should not assume that every foreign investor is selling irrationally. They may be responding to a couple of factors for this March to June factor: higher crude oil prices, rupee depreciation, relative valuations, global interest rates, geopolitical risks, and Indian corporate earnings. Or maybe opportunities in countries or markets like Japan, Korea, Taiwan, or Taiwan foreign selling happening. So foreign selling therefore cannot create a valuation opportunity. It can also contain information about genuine risk. It is neither proof, there is no proof that India has become an unattractive or And there's no proof that every decline should be purchased. What do we conclude from this? Can valuations give us a higher probability, a market promise, a model output? So I have seen and understood that when Indian market trades at a 10% valuation discount, the historical probability of an upward movement is like 70 to 80% with a 24% probability of a downward movement now. And that is a major indication lower starting valuations can improve prospective high risk rewards. And this percentage cannot be treated as a universal forecast, what I just gave you the numbers, because before you use the numbers, we need to know which index was tested, fair value calculations, and what was the sample period. So over future horizons, can we see an upward move which can be measured? How many vulnerable companies have not been considered? How many comparable markets observations existed? So to make this statement like 70-80% remain attributed to the upward expectations, it should not become that there is a chance of 70 to 80% chance that the market will rise from today. And I would reject any such statement suggesting 100% probability of equity market rise at a particular discount today. No equity outcome is certain. But there's a principle I would leave you on this point. A valuation discount can improve the margin of safety. It cannot eliminate any kind of market risk. So an apparently discounted market can become more discounted for that matter, because geopolitical risk can increase, interest rates can change and alter such assumptions which I just gave you. So large, mid and small caps, avoid the extremes. It would also be a mistake to conclude that every small and mid-cap company should now be sold. Smaller companies are not one uniform investment. Some have credible management, strong cash flows, and long growth opportunities. You may also consider that some of them may have weak balance sheets, poor liquidity, valuations requiring years of exceptional growth. Therefore, I would say that large cap does not automatically mean safe either. Large companies can also face disruption, excessive debt, governance failures, and prolonged earnings weaknesses. So the correct valuations, what I would say is, depends on 4 factors: the business quality, growth expectations, valuations, and portfolio allocation. This is just to explain to you that if any appreciation has pushed an investor's small and mid-cap allocation above the financial plan, this may justify any kind of rebalancing to be done now. It does not justify replacing one concentration with another. So you would say, Taresh, okay, large cap is okay, but what about flexi cap and multi cap? Do they offer or they vehicle for a good go ahead for a plan now? Well, I would say flexi cap and multi cap mutual funds as possible vehicles for navigating this market cap divergence at this point of time. However, these categories operate differently. For example, a flexi cap fund gives you the flexibility to the fund manager to move among large, mid and small cap companies without maintaining any fixed allocation to each segment. So that's flexi cap. While a multi-cap fund must retain specific minimum exposure across large, mid and small cap stocks. So this is the 2 distinction. It is therefore important to understand that this therefore continues to hold meaningful smaller company exposure even during periods of higher valuations or, for that matter, volatility today. Neither is automatically superior, for that matter, let me say. And therefore, the sustainability or suitability depends on the existing portfolio, risk capacity, goal horizon, and current market cap allocations. That would be the scheme's investment process and the volatility tolerance, for that matter, and the role of the investment will perform. A mutual fund category is an implementation vehicle. It's not a complete financial plan that buy one category of mid cap, small cap, flexi cap, multi cap. So you have to understand as per your financial plan what you need and then invest for a given horizon. Now the 4th shift I'm talking about is the AI investment boom. Is it a revolution, or is it already an excess, or is it just too overhyped? Or is it an AI revolution, which is an investment risk in the making? So, artificial intelligence may be one of the most important technical developments of our lifetime. Not an extraordinary technology which makes or doesn't make every sophisticated associated investment attractive at any price. The current AI cycle has been compared with the 1990s internet infrastructure boom also. At the times of 80s and 90s, we saw the similarities because in that internet boom, a genuine technology emerged, adoption accelerated, and capital expenditure increased. Hardware infrastructure companies attracted enormous investor attention, if you remember in the 80s and 90s over there. And the markets assumed exceptional future growth. The internet did not transform the world, yet many investors lost money because valuations became excessive because infrastructure capacity grew faster than the demand, and several companies failed to generate commercial returns that justified their market prices. Therefore, today the AI cycle may be moving through a relative capital investment sequence today. First, the enormous the data center capacity has to be built. Then the adoption and use of cases has to expand. Eventually, investors must discover whether productivity gains and commercial revenues justify the capital already committed. There are estimates that 5 largest hyperscalers would spend more than $1 billion on AI related capital expenditure during 26-27. So that's a warning that competitive pressure may encourage companies to overcommit capital before the eventual returns are fully established. You may ask me, why is this exact not a data, .com revolution replay for that matter? There are these are also important differences. So many leading AI investors today already have substantial revenue, profits, cash flows, and established their businesses. But during the .com boom, several companies had little more than an idea, a website, a speculative valuation. So today AI is already generating real productivity applications. And that means what? The investment still carries risks. Yes, because concentration in a few companies, higher expectations in these embedded prices, semiconductor and power bottlenecks, rapid software depreciation, growing capital requirements, and uncertainty about how the economic gains will eventually be distributed. Therefore, I can make two statements simultaneously today. Artificial intelligence can transform the economy, and some AI-related investments can still deliver disappointing returns. So you have to be cautious. Great technology is not great investment at any price. For you or for me, as Indian investors who may look at international equity exposures, the practical questions now would be like, how much of my portfolio ultimately sits in the same few technology businesses? Does my international fund substantially overlap with another international fund? Am I investing for genuine diversification or because AI recently performed well? Ask. And can I withstand a major technology correction without abandoning the investment which I've done? So do not reject AI, but do not purchase excessively, because every investment carries every investment you would make, therefore, maybe you're thinking that carrying the AI label. Separate technological potentials from investments has to be understood for suitability now. Let me come to the fifth shift. The hardest time to invest is often after the price moves. Planned versus emotional investing. My final investment insight comes from what I would call it a professional dilemma. When markets are rising, portfolios are profitable. Increasing equity exposure therefore feels very comfortable. But when markets correct sharply, the same asset suddenly feels dangerous, even though the price may have improved. This creates a behavioral contradiction. Why? Because when prices are high, investors demand bold action. When prices fall, they demand complete safety. This is often the reverse of disciplined investment behavior. And I've seen this over decades with my clients. So after a correction, investing carries a short-term reputational and emotional risk. If the markets fall another 10%, the investor, some of my clients or people have asked me, why did we invest when conditions were uncertain? And I would say, but if we wait for complete economic and geopolitical clarity, prices may already have recovered. Therefore, the market does not announce its bottom, is what I would. Therefore, a correction improves the price. It does not automatically improve the asset. That is why I would not frame the choice as bold versus safe. The choice as bold versus safe. That distinction is better said as planned versus unplanned. A planned action follows an agreed process. It protects the emergency reserve. It separates the near-term goals with the long-term equity for that matter. So it restores, but it does not exceed the agreed asset allocation between the financial planner and the client on the other side. It does evaluate whether the original investment case remains valid. And it avoids concentrating the portfolio merely because one segment has fallen sharply. Now here, another contrary view I would put in. STP, systematic transfer plan, which I use as a strategy versus an immediate investment. What should one do? Should one use STP to manage deployment, not the market risk? So an STP can now help you in a phase a substantial amount from the suitable source scheme into an equity. Let me explain. It can reduce the emotional pressure of selecting one perfect entry date into equity market. However, an STP strategy is not automatically safer and it does not guarantee a better return. Immediate investment may perform better if the market rises quickly. So in a STP kind of a strategy, staggered development or deployment of your funds may feel more manageable only if volatility continues and prices fall sharply. Therefore, the correct approach would depend on the size of the amount you're investing, existing asset allocation, your goal horizon, and the liquidity requirements. And obviously, tax and exit loads have to be understood as implications. Along with that is the market evaluations at that point of time, investor's ability to remain committed. And therefore, an STP manages that process of entry into equity fund. It does not remove any equity risk in equity mutual funds for what I'm trying to explain. So the three decision correction frameworks I would give you now, please make notes. 3 decision correction frameworks. Now, during a correction, separate the response into 3 decisions. Decision 1, must anything be sold? If the investments remain suitable for a long-term goal and the family has adequate liquidity, a market fall alone may not justify selling. Decision 2, must anything be rebalanced? If equity has fallen below the agreed allocation, then rebalancing may restore that original plan. And the decision 3 would be, how should new money be deployed? Immediate investment, staggered deployment, or retaining liquidity should follow the family's circumstances. For this decision, not a declaration that the bottom is arrived. The objective is not to prove courage. It is to act within, or I would say it is to act without pretending to know the next 3 months. And that's the STP periods I would recommend on a weekly basis. On this front of family continuity update, I would say that SEBI's new transmission reforms asking you, can your family claim your investments? And before I close this session, one important family finance development deserves attention. Now, SEBI has issued a standardized framework intended to simplify the transmission of listed securities, demat holdings, mutual fund investments after an investor's death. That framework includes fast-track processing for smaller claims and higher limits for simplified documentation. This is a welcome move, and I would say more of a humane reform. But it does not make estate planning unnecessary. The rule cannot tell your spouse which investments exist, where they are, what's the document They cannot update an absent nominee for that matter, or your wishes. They cannot reconcile contradictory succession documents or your will. And they cannot replace a properly considered will which you have made. Therefore, a nominee cannot facilitate access and transmission, but final beneficial ownership can involve succession laws and individual family circumstances. Now, let me give you a very short acronym for this. I call it the CRAME readiness test. C for consolidate every financial asset. L, link each account to nominees and succession records. A, align names, PAN, KYC, addresses, bank details along with your email and mobile. I, inform your spouse or trusted family members. M, maintain the records every year. Spend few hours in a year so that your family should not have to become financial detectives during a personal crisis. Even when you're alive and you cannot explain to them where are the financial assets, what to withdraw, or perhaps a medical or a contingency treatments or anything. I'll give you 5 actions this week. Let me conclude with 5 practical sessions. 1, stress test the household review. How higher inflation, fuel costs, and rupee weakening could affect your monthly expense budgets, loans, and other overseas commitments. 2, review your global concentration. Check out whether several international investments ultimately hold the same underlying few technology companies. 3, examine the market cap allocation. Do not chase large caps simply because appear to be relatively cheaper. Rebalance only after reviewing the complete portfolio. 4, create a correction protocol. Decide in advance when you will rebalance, how you will deploy substantial money, and which goals must remain outside equity. 5, complete the family asset allocation test. Something like give your spouse 10 minutes to identify your demat accounts, your mutual fund folios, your insurance policies, your retirement accounts, your foreign assets, nominations you have done, and the will. Whatever cannot be located becomes your action list for this week. Put in the comments what you've done, what you would like to do, and tell me also. Now, beyond these headlines, just a small recap, some better financial decisions I would recommend for you, or rather share with you my views. So this week's developments had one shared lesson. Oil prices can change, currencies can weaken, foreign investors can leave, global markets can move in opposite directions. AI can create extraordinary opportunities and dangerous expectations on the other side. And a market correction can make a better investment price feel emotionally less attractive. We cannot control all these events which I said, but we can control what? Put in the comments. Our liquidity, diversification, asset allocation, our documentation, our behavior towards our finances. Therefore, financial intelligence is not the ability to predict every kind of storm which may be coming up, or you read somewhere told by somebody I'm going to predict a storm. It is actually the ability to build a financial system that can continue through such predicted storms. If you want to examine how your investments, retirements, protection, taxes, estate records, and family goals can fit into one structured financial system, then start your structured financial orientation at my site tareshbhatia.com. So plan today, protect tomorrow, protect always. Hi, I'm Taresh Bhatia, a certified financial planner, CFP professional, freedom specialist, financial freedom specialist, and AMFI registered mutual fund distributor with ARN 85505. This program is educational only and for general awareness only. It is not to be considered as personalized investment, financial or tax or legal advice, nor a recommendation to buy or sell or switch or redeem or hold any particular product. Historical valuations and my explanations, market probabilities and my understandings and past returns do not guarantee future performance. Market conditions, taxation, product suitability depend on individual circumstances. I may be earning commissions from the distribution of mutual funds and related financial products. Please consult the appropriate qualified financial professionals before making any financial decisions. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. Thank you very much for joining me in this special The Taresh Weekly Financial Intelligence Report. I'll see you next week. Till then, be happy. Consider your investments are very happy. Thank you.